Hey everybody, it's Chris Johnson with Monday Morning here talking about the most dangerous stock in the market today. It's not GameStop or even AMC. Those stocks have been on wild rides. No, this is a stock that you and I both know and love very well, and that's part of the reason it's the most dangerous. Don't worry, I'm going to explain exactly how this works and what it means. It could create an opportunity to buy a huge dip over the next couple of weeks. So stick with me for 5 or 10 minutes. This is information and an approach you're going to be able to use on any stock, so well worth your time. Let's jump into it right now. All right, I know what you're saying. CJ, NVIDIA is the stock. It's the most dangerous stock on Wall Street? No way. You're going to start writing comments. You're crazy. You're off of your rocker. Forget about it. I'm telling you that it is the most dangerous stock on Wall Street. I have seen this situation before with Apple. I've seen it with Microsoft. And in all those cases, the risk reward that we all look at, especially as earnings approach, has flipped over, and it's more risky than it is rewarding at this moment to hold NVIDIA. I'm going to explain that very quickly, and I'll give you a little bit of a history lesson. But first, let me give you a fundamental story. And this goes back, you may have heard me talk about it, to my 7th and 8th grade education. I was good at math. I took some advanced math classes and felt very confident. Almost to the point where I'd go home and brag to my parents, I don't even need to work on this. The homework, I leave my book at school, et cetera, et cetera. But I learned early that it was better to bring my book home and study and go through the motions as if I was struggling with the class and even talk it up as if I were going to get a B in a class. Because that way, when I brought home an A every quarter, my parents would be happy. We'd do a little celebrating. But flip it around, and if I told them I was bringing home an A and how easy the class was, their expectations would go through the roof. And then if I brought home a B, forget about it. I'd be grounded for a week or two because the expectations were up here. It's no different with NVIDIA, with Microsoft, with any stock. You can control the expectations and the narrative as a company, and NVIDIA has kind of done that, but when Wall Street gets out of control with their expectations, that's when a stock becomes dangerous. And it's happened with NVIDIA. Let's take a look at this chart, and it's a little history lesson now that you've got the analogy. So, a chart of NVIDIA. It kind of looks like the chart right now, but there's a huge drop off. This is NVIDIA back in 2005 through 2007. It's the first time I purchased NVIDIA shares myself, way back in 2005. If you remember, they were getting into video graphics. They actually had the separate cards, and they're still putting some of those electronics, those components on the motherboards, but for the most part, they'd switched to a card that you could swap out now and put more computing power on your displays. It was a wonderful advance for everything from computers like this to gaming computers. So they broke in and really took off. Now, at this point in time, you had about 5 to 6 analysts that covered the stock. That's it. 5 to 6 analysts that covered the stock. And of those, there was only one strong buy recommendation. So everybody else was down in the hold and sell camp. 80%, maybe 78, 70, some mid 70% of them were in the hold and sell. So with that small amount of buy recommendations out there, there was all kinds of potential for the stock to go higher. I always talk about this as if it were potential and kinetic energy. Sorry for me going a little nerdy here, but when analyst recommendations are low, and when your and my expectations are low, there's more reward. There's more kinetic energy that can take us higher, right? That potential energy down here starts to take off and drive the stock higher as we get more and more bullish. Now, what happened here is that you had 93, and a couple other analysts had jumped on board, but 93% of the analysts at this point had the stock as a buy. And why not? It had gone up 300-400% or so. But that's when the stock had become dangerous, and not even close to as dangerous as it is now. They had a little misstep on earnings, and the stock dropped 80% of the value from that. And of course, what follows there is those analysts jump out of the stock, out of those buy recommendations, and they start recommending it as a hold or a sell. And you start back. We've got a lot of potential energy there again. Let's look at another period, and I can fast forward here, 2015. Same situation. This stock, notice how it just kind of went dead. They were doing a couple of different things to try to get into the automobile industry, heads-up displays, etc. Nothing was taking off. And then all of a sudden, we had the GeoForce come out, the GPU, and the company announced that they had a supercomputer that you could put under your desk. Also, what do we have going on here? Well, people figured out that you could use that GPU, that power on those cards, to mine Bitcoin. Boom. Right in here, we had around 9 to 11% of the analysts recommending it as a buy. And once again, we got to the point where you had 90% plus of those analysts recommending it as a buy as we rolled into the end of 2018. Now, we had a couple of different things that happened here. The company was trying to do some acquisitions and trying to grow. The big thing is we had more analysts that came into the group. So we went from single digits to now we're talking about a company that was tracked by 20, 22 different analysts and giving those buy recommendations. It gives a little more steadiness to the stock when you have a larger analyst crowd that's tracking it. But once again, a misstep shaves the stock from $70 down to $30 and quickly came back up because, again, they had now taken over and adapted into a company that was providing that mining power for Bitcoin. Now, we saw all of the falls of the bear market that kicked off in the end of 2001 into 2002 take NVIDIA lower, and they also missed an earnings announcement then. They dropped 18% after they missed that earnings announcement. But once again, another overloved situation as 96% of the analysts that track the stock, and now we're up in the 30% or the range of 30 analysts tracking it, 96% right here. So overloved, and it's either a misstep or, in this case, the market providing another headwind. Now we take it to current times, and the stock has gone to new all-time highs, trading just below that $1,000 mark, and the analysts haven't learned a lesson. So this week is earnings on Wednesday after the close. Notice that the stock after last quarter, their last grade card was straight A pluses. The company came in and blew away expectations, which is what they had to do to stay at that level just below $1,000. If NVIDIA had come out and given us any type of blink on that earnings announcement, their outlook, earnings per share, revenue, maybe the demand is ebbing off just a little bit. The stock pulls down a good 20 to 30% right out of the bat. Instead, the company comes out and delivers a perfect report, as if the analyst or maybe even a Hollywood screenwriter had written the perfect earnings report. Notice what's happened, though. Despite that perfect report, there's your earnings date, the stock has done nothing but go sideways. And sure, we can talk about inflation and interest rates and all of this stuff, but this is NVIDIA. This is a company that went up more than 500%, 600%, 1,000% under all of those problems that the markets were facing. It is the market's golden child. This is the fact that all of those expectations have already been priced into NVIDIA's price. And when the company comes out and absolutely blows that number up and gives a perfect report, and the stock still ends up a few days before its next earnings report at the same level, my friend, that puts us in a terrible risk-reward situation. And that's what investing is all about, especially if you're looking ahead of earnings. So we just had 4 analysts raise their target prices on Monday ahead of a Wednesday earnings report. It's telling you that Wall Street thinks this thing is going to be perfect, this report that we get on Wednesday. And if you use last quarter as your example here, okay, sure, it may be a perfect report. And I got to say, if it is a perfect report, you're going to find the stock break through the 1,000, maybe go up to an 1,100. Your analysts, where you start to run into some resistance with the target prices, is up around that 1,150 to 1,200. Maybe we start to trek that way. But it's not an if, but it's a when NVIDIA has a little bit of a misstep. When they say that the forecasted revenue maybe is going to be flat, or demand is starting to, or maybe they're getting a little more competition from someone else, and they own this industry right now, that's when that risk comes out to play. And And I always use the analogy not only with my grade card, but I like to use a crowded theater and somebody yelling fire. If there's a little bit of a whiff of smoke in the next earnings report or the one after that, this is the company that has so much selling pressure bound up in that stock because everybody's bullish. Everybody owns it. And when everybody owns it, it makes it harder for the stock to go up after a great earnings report. But if everybody owns it and they miss just a little, or even just suggest that they could miss in the next couple of quarters, that's when you look at the downside. So our reward right now is limited to the upside. Our risk is limited to the downside because you're going to have people coming in and buying the dip, but it is magnified compared to what we see to the upside. So let me play it out in a summary for you. Wednesday after the close, the number comes out. They give a report that is in line with expectations, nothing fancy, doesn't blow the cover off the ball, but instead meets and an outlook that is in line with analysts' expectations. You're looking at a situation where the stock is going to break down below the key 50 and 20-day moving average, and the first support that is going to come from round numbers at $900. $800 is your first stopping price or the first target where you start to see some technical buying coming in, and that is because that's the level that we saw in April. It all comes down to round numbers. We're talking psychology when we're talking overloved trades. Well, psychology of a large price stock like this is that the round numbers are going to start to play as support and resistance. 800 is your first opportunity to buy, and then from there you go down to a $700 level, a price that we visited in February just before the buy the rumor rally that took the stock all the way up to that $950, which is where the stock was priced for perfection. And again, I would say if we had a little more of a buy the rumor rally here, it would definitely be priced for perfection. But this flat pricing tells you that the market needs more exceptional earnings and outlooks from NVIDIA to really start to qualify that valuation that we put on the stock. On the downside, 800, 700, but that 200-day moving average, which is this blue line here, is the first level I look at for real long-term support. It's at about $625, and that's the point where I start to back up the truck and increase my position in NVIDIA. I do, for full disclosure purposes, own NVIDIA stock, and I do own a Leap, a long-term option on NVIDIA as well, and would like to have a little more exposure, but I'm diversifying among other AI companies and technology. On that note, it could be a burning question for you. Well, CJ, what's a stock out there that's not overloved, that's got low expectations, that could outperform simply because the analysts haven't figured it all out? Well, I've already talked about Supermicro Computer Incorporated, and the ticker symbol is SMCI. This stock, instead of having 56 analysts or 55 analysts, the way NVIDIA does, this company is down in the teens. And they're starting to add to the crowd right now as Wall Street analysts come in and start to recommend Supermicro Computer Incorporated. The chart doesn't look as pretty right now as NVIDIA's, but it's outperformed NVIDIA over the last year. And it is one of those discovery phase stocks, kind of like NVIDIA was back in 2017. Another one from the group in AI, Palantir. It's the name that everybody kind of loves to hate, including the analysts. Right now, you only have 40 analysts that are covering that stock, and only 21% of the analysts have it ranked a buy. Palantir has been showing a little bit of flexing a little bit of their big data muscle here, getting some new contracts with the government as that's their primary, but they're going to start to work out into the healthcare area as well. It's trading right around that $20, $22, kind of a tight trading range. Peter Thiel, one of the original investors in Palantir, has actually been selling his shares aggressively. Could tell you something that's going on that we don't know about. Nonetheless, a stock that Wall Street has kind of ignored. So let me summarize it for you very quickly. We head into this earnings report with NVIDIA on Wednesday afternoon, and the analyst community and the fact that you and I have already bought it makes it the most dangerous stock on Wall Street, especially this week. Any slip up on earnings when it happens, not if, because it will happen at some point, is going to cause the stock to see exaggerated selling pressure because everybody owns it. You'll see a lot of profit taking that'll take it down 20, 30% or so. And it's done it in the past. Its last earnings miss back in 2022 took the stock down almost 20% in a very short period of time. The market's still going to look at this as a long-term buying opportunity. I will as well, increasing my portfolio's holdings in it and maybe picking up some options on it as well. But until we hit that larger correction, this stock remains the most dangerous stock on Wall Street. Names like Palantir and Supermicro Computer Incorporated that are showing positive fundamentals and positive technicals, but no love from Wall Street or investors, individual investors. They've got more on that reward side than the risk, which is what it's all about, risk and reward. Hope this helps you. You can apply this approach to any stock you're looking at, just like I did with NVIDIA back in 2005. That's what got me on it then and keeps me in the stock now, but with a little bit of an eye on the danger that's involved in holding right now. Chris Johnson with Money Morning. I wish you the best trading success and hope you have a great day. Don't forget to comment below and like and subscribe to the channel. Have a great day.